In the previous week, the trading in the rupee was confined in the range between 74.45 to 74.60, the high and low for the week being 74.40 and 74.6550 respectively. It was rumored the RBI to have bought close to $2 billion during the last week in order to make the rupee more export competitive amongst emerging market currencies. The intervention stance from RBI clearly convey their intention to maintain the rupee well above the 74 mark. After recognizing the increase in external demand, RBI will be tolerant to see a gradual weakness in the rupee exchange rate in relation to the scenario of domestic economic fundamentals and any adverse external developments. While we expect the rupee to hover in the range between 74.00 to 75.00, the sentiment on the domestic currency is data-driven both from domestic and overseas markets. Hence, the importers and exporters have to monitor the market conditions very closely and hedge their exposures at the appropriate levels to derive the benefit of a favorable forward exchange rate against import payables and export receivables. Rupee has gained due to constant flows on account of IPOs and a broad risk-on mood. Strong inflows into the domestic equity market could lift the rupee higher to test its strong resistance at 74.00 level. The short-term range for the rupee is now confined into the 74.00 to 75.00 zone. The foreign inflows could restrict any sharp depreciation moves in the rupee, but recovery in the dollar could limit the gains. We expect the rupee to trade in the sideways range of 74 to 75 for a few more weeks, while the IPO-related dollar inflows led by Zomato and Paytm issues could support the rupee to rise. The negatives for the rupee originate from higher crude oil prices and weaker domestic fundamentals, thus making the rupee to trade in the above suggested range with a weaker bias. The positives and negatives for the rupee shall continue for some time, but the market focus is bearish for the domestic currency to test the 75.50 support on emergence of any definitive cues on Fed tapering over a period of time. Fed Chair Jerome Powell insisted that it was too soon to withdraw the central bank's FT monetary policy support for the economy. Powell once again shrugged off the spike in inflation as only temporary, saying in his testimony before the Senate committee on Thursday that it would be a mistake to act prematurely and that economic conditions for tapering bond buying was still ways off. The dollar fell to 92.33, falling back from the high of 92.83 seen earlier this week. Once the dollar inflows position recede, it is quite possible for the rupee to appreciate to test the support at 75.50 in the next 3 months time frame from now. Exporters and importers are well advised to keep the above currency trend in mind and hedge their exposures appropriately to obtain a favorable forward exchange rate against their exposures falling due over the medium term. The 10-year USD bond yield is trading lower at 1.32%. The 2-year US bond yield is steady at 0.22%. The spread differential between the 2-year and 10-year bond yield is now at 110 BPs, widened from the low of 102 BPs registered on 8/7/2021. Domestic equity markets are trading into the consolidation phase. Though the portfolio equity investors withdrew $600 million from Indian equity markets, the investment from domestic investors and DFIs has been encouraging to lift the BSE Sensex to record a new lifetime high of 53,266.12 on Thursday. From Monday to Thursday this week, the Sensex has gained by 1%, targeting to reach new lifetime highs almost in each passing week. An easing domestic COVID situation and IPOs could limit any outflows from the market. The forward market has now returned to show normal conditions and trading at appropriate levels for maturities up to 12 months tenor, broadly representing the interest rate differential between the US dollar and INR for corresponding maturities. RBI had earlier resorted to undertake sell and buy swaps with banks to extend maturities coming under the forward dollar purchase position of RBI. From May 2021 onwards, the central bank halted the swap market operations with the banks, which had resulted in normal conditions to prevail in the swap market. Currently, the 3-month to 12-month forward dollar premia are trading between 4.10% to 4.50% per annum respectively, and the forward curve is demonstrating a steepening pattern at the medium and long end. With normal conditions ruling in the forward market, importers and exporters can choose to hedge their payables and receivables at the appropriate spot level to derive a favorable forward exchange rate in settlement of import bill payments or crystallizing the exchange rate against export realization.